Hi, my name is Todd Doleshal with Elevated Retirement Solutions. For those of you who may be reviewing this from boarding from others, today, during our recap of our third Wealth Accelerator series, we're going to be talking about the three different ways that you can save and invest for tax purposes and what some of the pros and cons on those are, as well as how to read some key information on your income tax return that will give you an idea and sense of whether you might be over or under balanced. Why am I talking to my clients about this in June? This also happens to be an excellent time to review your taxes. And if you are in the market for interviewing CPAs and accountants, the summer historically is an excellent time to do so because you're less busy, you're able to take your time, properly interview those, and make sure that you're much more likely to have success with the accountants and CPAs you might be working with. So if you have any follow-up questions on this, please don't hesitate to reach out and let me know. So to begin, the three main tax buckets are going to be tax deferred, tax free, and then taxable. And we're going to talk about each of these going forward. So tax deferred are what I see are the most common that most people save into. Some examples of this would be a work 401k, 403b, traditional IRAs, etc. These offer really phenomenal benefits because let's say you're making $150,000. You save 10,000 of that into your 401k through work. You actually lower your adjusted gross income by $10,000 in that tax year down to 140,000, all else being equal. So it's a pretty good deal. So if you're at a high income tax bracket, it's a great way to get a short return on your money. The downside though is let's say you invest in that 10,000 and then it grows and does very well and quadruples to 40,000 over a period of time. Could be so lucky. The nice thing about a 401k is that you don't pay income taxes on that gain along the way while you've been saving and investing into it. So that's another nice positive with it. The downside is if you pull all 40,000 out when you retire, 59, some plans allow you to pull the money out at 55. Then at that point in time, you're going to pay ordinary income taxes both at the federal and if you're at a state income tax level, then you also pay state income taxes too. So the reality is that you don't actually keep all $40,000 of that distribution when you pull it out because of the taxes that you have to pay. Now, this is also highly consequential, especially for those who are retired or starting to collect Medicare, because your premiums that you pay on Medicare, for example, go up and down with your income that you report from the previous year. So not only could you be in a situation where you pull a bunch of money out, pay a lot in taxes that year, the following year, you're also going to get penalized extra because you're going to pay a lot more potentially in Medicare premiums. And in fact, I've been referred to people where they didn't understand this strategy, pulled a bunch of money out for a home remodel or medical expenses, and then the following year, their Medicare premiums quadrupled, which really startles people, especially considering the massive inflation and cost of increase in goods and services that we've seen over the last 3 years here. So that's my goal in teaching this, is to give you better tools to help us all fight the inflation that we're facing, unfortunately. And a great way to do that is to be more tax efficient with your financial plan and your investment strategy. Now, the other main account is tax-free. Of course, that sounds the best and oftentimes is. A great example of this would be a Roth IRA or a Roth 401k. So going back to our example, let's say you made $150,000 in 1 year, and you elected this time instead to put that $10,000 instead of into the regular 401k into a Roth 401k. Now, you don't get any tax deduction in that same calendar year for doing so, but all of that growth that you received from that point going forward, if it grows to 40,000 in our example, guess what? Once you reach the appropriate age, you can pull all 40,000 out, no taxes, penalties whatsoever. So that's an excellent way to create some tax diversification for yourself, especially in retirement for those larger unexpected or large purchase items. So really, really phenomenal for that. Unfortunately, they do limit the amount that you can save into these tax-free accounts. Roth IRA is only $7,000 in any 1 year. If you're 50 or older, you're looking at $8,000 for the catch-up, which oftentimes isn't enough for someone to achieve their entire financial goals and retire just with using tax-free vehicles. And that's why it's good to have a combination of all three. The third is the most interesting and the most complex, which are taxable accounts. So examples of taxable accounts would be your checking account, your savings account, real estate, brokerage accounts, anything that's not in a traditional retirement account, such as IRA, Roth IRA, 401k, SEP, so on and so forth. Those are generally speaking what are called non-qualified accounts. Now, non-qualified accounts, going back to our example, let's say you put $10,000 into savings instead of into your 401k or Roth 401k. You don't get a tax break for that, putting that money into the bank account or savings account, of course. Then let's say you're getting 4% interest, making up that hypothetical interest rate. Any interest that you generate from the bank or savings account or CD or otherwise is going to generate what's called a 1099 that adds to your ordinary income that you have to pay when you go to file your taxes. So if you're at a roughly 25% tax bracket, that 4% that you made actually is closer to 3% net of taxes. So that's why oftentimes other examples, such as tax-free municipal money market funds, are phenomenal. Municipal bond funds also can be a great way if you hold them for more than 12 months to generate income on a federal income tax-free basis. Oftentimes, they're usually diversified in the form of mutual funds and ETFs, etc. State income tax rules may apply, but for most people, the majority of what they pay in income taxes comes from the federal side and not from state income taxes. So more specifics, we need to go and dive deeper with each person on. Also, with the non-qualified account, you also have the ability to invest in pretty much anything. You can invest in stocks, real estate, and so on and so forth. And let's say you take that $10,000, you hold on to it for more than 12 months, then you get what's called long-term either capital gain or loss tax treatment, which is really what we want. That's why oftentimes short-term trading or day trading, while it might sound lucrative, any and all gains that you make in those accounts, you have to pay ordinary income taxes on. And then conversely, if you lose money in those accounts, you don't get to write them off on your tax return. Whereas if you just simply held on to that investment for 12 months or longer, if you have a gain, you pay long-term capital gains taxes, which is somewhere around half of most people's ordinary income. And then conversely, if you have a loss, you can write that off up against your tax return up to $3,000 in any 1 year. So a common strategy could be if the market's down, you have an investment that you've held on to for more than 12 months, you can intentionally lock that in as a loss, you get a nice tax break, and then turn around and buy something that's even more aggressive at a dip, thereby buying low while the market's down, getting a nice loss, which is what's called tax loss harvesting, and then on we go. So lots of different ways to be creative with this. And it's really, really fun. And that's one of the best parts that I enjoy about my job as we look at this from a planning strategy. So now I'm going to share my screen where we're actually going to be walking through the personal income tax return on your 1040 to show you where all these come out to play here. So what we're looking at is a personal income tax, what's called Form 1040, that you can download from online. And I recommend if you are looking to download this, go directly to the IRS website link because they have this there for you. Now, when we talk about all the different options that are out there, we're actually focused a lot on the sections 2 and 3 here. So in sections 2 and 3, as I blow the screen up here, most people, when I start working with them, the bulk of what they have in any interest or savings in these non-qualified accounts primarily is in the form of savings accounts, CDs, and so on and so forth. And all that generates taxable interest and income here that flows through on line 2B. However, if we were to say invest in tax-free money market funds, municipal bonds, so on and so forth, then you're going to see a lot of your resources over here on the left for section 2A. So long story short, just to call this out as one potential option, if you see on your 1040 and you don't see any money or significant amount of money on a percentage basis in line 2A, that could be an opportunity for us to examine this and find out some other ways to invest in a much more tax efficient way. Similarly, too, when we talk about qualified dividends and ordinary dividends, if you hold on to an investment that could have been treated as a dividend, which is what you want, but you hold on to it for less than 12 months, then that generates ordinary income and interest instead of being taxed as a qualified dividend, which is much better for you on the left-hand side. So in short, when we look at the income tax return here for 1040, We really want to try to shy away, if possible, from the areas on the right, because those are all going to add to your adjusted gross income on line 11. And then conversely, we want to really load up on the things on the left here, because these are areas that are going to get taxed at long-term capital gains and or not potentially taxed at all. Now, little disclaimer here, of course, I will say this, there is no perfect tax strategy, right? There's lots of different ways to look at this, but the key question is, when do you pay the taxes, right? Do you pay it when the money goes in? Do you pay it when it goes out, or along the way, or a combination of all three? So for that reason and the flexibility around non-qualified accounts in particular, I do typically recommend a good percentage of your wealth being set aside in those accounts, because they are very accessible and flexible. And know that in certain situations, if you're at a pretty high income tax and generate a very, very high amount of tax-free income from municipal bonds, you may be subject to alternative minimum tax, or AMT for short. So that's where working with someone like me, financial advisor, and your CPA in coordination together can really help put together a solid game plan for you and give you the pros and cons, because there is no one size fits all approach. And that's the beauty of this, is that you really can customize this along the way. So thank you, everybody, for listening to the recap of the third Wealth Accelerator Series. I hope you found it informative, and please email me any questions, thoughts, or concerns. Thank you.